starting off, the important dates to focus on is going to be December the 13th and the 14th, which is going to be that FOMC meeting with the CPI inflation data. Charlie says over here that November was the 20th consecutive month that inflation will have outpaced the growth in the wages and a decline in prosperity for the American workers. This is the primary reason why the Fed will have to continue to raise rate hikes at the next FOMC meeting, which is on the dates I just showed you. Over here, he also outlines that the spread between the 10-year and 1-year Treasury yields has moved down to negative 1.8%, which basically the prior 8 recessions in the US were all preceded by an inversion in the yield curve relationship, exactly as you can see within this chart over here. So what I recommend is go and have a look at this video, the bullwhip effect. I did release that on Saturday, so a lot of the regular viewers may have missed that. It basically outlines the relationship between these yield curves and basically differences within the economy due to the effects of COVID and slowing down of the economy, shutting down the economy, quantitative easing, quantitative tightening, and stimulus checks, and that whole relationship of how they intertwine with in one another. And that ultimately leads to basically the market overcompensating and undercompensating on various different sectors. And that ultimately leads into a recessionary environment. But one important thing that I do want to say with regards to that is the recession may not come as soon as what you believe. There are different markers and indicators, which I did go over on the weekend as well, which suggest that it may be further out than we anticipate, because a lot of these yield curves, people are obviously sounding the alarm like a canary in the coal mine, as if it could be weeks away. But the reality is that it could be only within another year or so. So do keep that in mind. It's just an early warning sign. Now, I wanted to dig into this tweet thread a little bit. Bear with me. It is long, but it's really worth the read. It's fantastic. It's by Fabian D. And he says, we just got through a big week of data releases. And as promised, here are my updated views for the traditional finance and crypto assets going into the 2 most important macro events of the month, which is the CPI on the 13th and the FOMC on the 14th. And he says, to give a quick recap of the 3 largest data releases from the last week, both the PCE and PMI came in cooler than expected, while the November employment report surprised to the upside, with non-farm payrolls and average hourly earnings both coming in substantially hotter. So you're getting this whole whipsaw effect, right? Some things are cooler, some things are hotter, and basically the market keeps jittering. You have bulls trying to front run, then bears get excited. It's all over the place. But he says, but the biggest narrative of the week was about how Jerome Powell surprised the markets in his speech on Wednesday by coming out with a far less hawkish tone than investors were expecting. And as a result, yields or dollar fell while equities continued to rally. He says here, all of this was positive for the markets last week, but also puts us in a precarious situation going into the December CPI report, as investor positioning is once again leaning too far onto the long side of the boat for my liking. And that's 100% true, right? Every time they basically thought, well, now there's a pivot, we're going from 75 basis points down to 50, and then the other numbers came out, and now it's back on the 75 basis point probability. And therefore, the market proceeded to rally, and it's basically led the market into an overbought situation, which he says here, from a momentum perspective, the SPY, which is the stock market S&P 500, is overbought and banging against the upper boundary of its trend line, while the VIX is back to its own yearly lows. I also expect the bulk of the move in yields or dollar and oil to be behind us, so as to not provide major tailwinds anymore. I do want to tie in again for those of you guys that may have looked at the thumbnail and you see that it says, well, there is longs loading. I'm going to show you why. What he's saying is 100% true, that it's overbought and we're coming into resistance, but I'm going to show you why in the short term there could be some further upside momentum. He says, yeah, as for the upcoming CPI report, we know that it's all about the surprise in the actual numbers versus expectations, and unless you think that you know better than leading economists, this, it is wise to assume a coin flip on whether it will come in higher or lower than forecasted. Basically, we don't know what the CPI numbers will really be. Inflation is known to be sticky and volatile in nature, and just because it came in on the cool side last month does not mean that it has to do so again. Remember the whipsaw we got back in the August-September readings, yeah? And I covered that as well in this show, the whole whipsaw effect, and basically how the market environment that we're in right now is very similar to exactly what happened in August. And you can go look back at price-wise in both crypto and the stock markets in August and see what happened after that. He says, also, when looking at it from a risk to reward perspective on price action following either outcome, the upside seems limited, even if it does come in cool, given when we where we already are. And he says the S&P 500 at 4,100 is already only 15% off of the highs as we head straight into a recession. And he says, and on the other hand, repricing to the downside will likely be swift if we come in hot, considering market positions and the eagerness of fund managers to protect profits right before their juicy year-end performance bonuses come in. Furthermore, I think, so basically he's talking about the potential for a Santa Claus rally. And he says, furthermore, I think we can almost be guaranteed to get a hawkish version of Jerome Powell if we go into the FOMC at elevated levels. Optimal game theory should result in free optionality for the Fed if they remain hawkish. So he says, all in all, I see it as an EV play going into the week of the 13th from current levels. I expect to range between 39 to 41 on the S&P, and I'll be slapping on a few shorts as we go, likely via buying of puts to play mean reversion in the VIX too. Now let me bring that back into crypto. So essentially what he's saying is he's looking for further upside leading into the meeting, which I agree with. I think that makes a lot of sense. People are going to claim the bottoms in, Santa Claus rally. You're going to see on the S&P 500, we probably, when I show you the chart in a moment's time, we're probably going to break that long-term diagonal that we've been holding since all-time highs, and that will give additional confidence to the perma bulls that basically it's up only from here, which it won't be, and you'll see why. So he says, crypto has already been trading heavy relative to equity since the FTX collapse, and for good reason. There's simply a lack of outside capital willing to come into the space right now. I don't want to be that guy, but the higher that we go, the more ripe we get for exit liquidity. And I think let's end it off over there. He does also mention over here, which I also want to emphasize on. Now, I don't want to come off as a bear here because I'm not. In fact, long term, I think that we're already in a golden DCA range for many assets. But near term, I'll be looking to de-risk or take tactical short opportunities the closer we get to $18,000 on Bitcoin. Now, keep that number in mind, $18,000. It sounds very familiar. For those of you who watch the show regularly, you would know those are the levels that I am looking at. But tying in with what he said, dollar cost averaging, I do want to emphasize on that. If you go look back on the pinned tweet in my Twitter account, there's the link above me over here. If you're not following me, go follow me there. There's an amazing tweet thread there, which I said I'd be allocating 25% of my portfolio. I'm using a DEX for that. So this is Biswap. They are one of the sponsors. You can basically purchase any coin that you're looking to get on the Binance or Ethereum smart chain, and you can send that straight into cold storage. So if you are interested in that, there is a link as well in the description below. Click that below and it will take you through there. Now, I wanted to tie this in with the tweet thread from Michael over here, and he says that I believe the conditions now favor an imminent stock market crash. And what I don't want to go through the whole thread because the other one was long already and this one's also long, but I do want to focus on one particular part over here. So he basically shows here the lumber relative to gold ratio, and he shows here, let me just find this. He says, here we go. Here, the internal tone of intermarket relationships is changing. Lumber relative to gold keeps hitting new lows, and utilities relative to stocks are resuming their advance. And he goes on to summarize, let's see over here, what is the catalyst? There's a non-zero probability that the FTX collapse has a delayed spillover to stocks. A margin call in one asset class is never just isolated in one asset class. Stocks collapsed a week after the Lehman Brothers filed for bankruptcy in 2008. And he says, my point is that there are lags, and that markets have a funny way of surprising the crowd out of nowhere. It is not impossible to see a scenario where the butterfly creates the hurricane, and treasuries are clearly agreeing here despite strong unemployment data. So what you'll find is when you have a look at that lumber versus gold, basically anytime that chart inverts as well, it does precede a recession. So it's another one of these charts that tie in with this whole video that I showed over here. So definitely go and check that out. But one thing that will take all of these bearish narratives completely off the table is this. So all the forecasts that we have of lower prices in the, let's call it the midterm, so leading into probably Q1 of 2023 is basically my target for a potential market bottom. That completely goes off of the table if you see that the zero COVID policy in China basically gets lifted. And it says here by Wu Blockchain, which just came in, Morgan Stanley is bullish on Chinese stock market again after nearly 2 years, saying that as the Chinese government continues to stop COVID zero policy, it raised the Chinese market to overweight. Target price increased by more than 10%. And over here, he says, as China fully lifts the zero ban, it's expected that the Chinese economy will start to recover in the Q1 of 2023, enter a period of expansion in Q2 and Q3, and achieve a GDP growth of 5% in 2023. And that will drive economic or global economic growth, which it will. As soon as China lifts this, that will be an immediate catalyst for bulls to basically take back control of the market. So keep a very, very close eye on what's going on in China. That is one of the things that I would be looking at to basically cancel out all bearish narratives. Now, very quickly to touch on this chart over here, this is Bitcoin on a monthly chart using the Heikin-Nashi candles, which basically is that Japanese candlestick pattern. And I have it on a log chart over here. What I want to basically outline, and let's grab an arrow to showcase this. If you take a look at these areas over here, I know not much price history, but typically what you see is a sell-off followed by a sideways consolidation. You have a bull run, major bear market sell-off, and again, green box followed by sideways consolidation. Then you have major bull run, major sell-off, and then sideways consolidation. Same thing, bull run, sell-off, and now you'd be expecting a sideways consolidation once the bottom is in. The reason that I'm mentioning this to you is because I don't want you to panic. I don't want you to get extreme FOMO if the market does finish selling off. Basically, let's just say that's the end of the sell-off. You can expect that there will be sideways traction for at least a couple of weeks to months, which will give you the opportunity to accumulate. It's happened every single time, guys, every single time. Just go look at the data. This is a high time horizon. It's a monthly chart, and look at how many months each time those green boxes remain there in a sideways fashion. So Bitcoin hasn't changed though. Looking at Will Clemente, says nothing has fundamentally changed about the Bitcoin protocol except for its fiat exchange rate. And that is 100% true. When you look at on-chain metrics, there really is no difference. When you look at a number of active addresses with a 14-day moving average, they have just continued on upwards. Let's go on to the block height. Block height continues to go up. The issuance of Bitcoin also continues to go up. And mean hash rate, which is the miners, basically are the miners continuing to mine Bitcoin, continues to go up over time using high moving averages, 14 and 30-day moving averages. Therefore, Bitcoin network continues to remain strong, and it's just the price that continues to go down because it's considered a risk on assets. So as long as you can make that adjustment in your head. I know crypto Twitter keeps going through different narratives, right? First it was gold 2.0, then it was an inflation hedge, and I don't know what will be next, but treat it as a risk on asset because that is the way that fund managers do. Go look at any of the top funds in the world and their portfolio allocation. They always put crypto into the riskiest of their bets. So you should do the same thing. Now, price-wise, what is going on over here? Weekly chart, I just wanted to outline this. I told you that relief rallies could potentially come into this zone. That is the $18,000 to $19,000 level, which ties in with the tweet thread that I just showed you. That would be forming another lower high within this region. And I warned you of that over a week ago. Those are the potential upside targets. Once we get here, we reevaluate. What that means is you could have gone long. Okay, let's be realistic, not from the bottom there, but I think I called around 16K potential to go long in the short term with targets up to this region. And when we get here, we reevaluate. So I'm still holding this chart as a potential scenario to play out, and then we can take it from there. Volatility is picking up. Ironically, it's picking up to the upside for now. So let's see if this can continue. Middle Bollinger Band on the weekly chart is coming in at 19,600, and that's declining with each week. So keep an eye on that zone. The Bitcoin chart using our moving averages, this is talking more to the longer term investors. Volume continues to decline, falling off a cliff over here. And you can see, looking at price, it is coming into the midterm moving average, the medium time frame, which is the green one over there. And we need basically, for bulls to get control, we need all of this to recover, right? So you need price to first move higher. Once price moves higher, you'll have the short-term moving average turned up, the medium-term moving average underneath the short one, and then the longer term one also curling up. Only when you start to see that type of an environment with price above all of that, as a long-term investor, would I start to go long. Short-term is a different thing. So I hope that helps with regards to if you are an investor. Now, Haas shows here all bear market rallies in 2022 ended when the VIX was this oversold. At the same time, the market got investors all bulled up, which is the perfect condition for a major rug pull, which is 100% the case. So let me click on that. Have a look. Anytime a touchdown within these levels, that marked a major top. And I have the exact same chart over here. Look at this one. Let me just zoom out a little bit so you can see the history. But anytime that price, there you go, anytime that the VIX got that low, it marked the major tops in the prior year. Now, let me just make this a bit bigger. Oh, excuse me, give me 1 second. Let's just turn this. There we go. So let's spend some time on this chart. What I want to mention over here is, you will notice, right? Firstly, we set in the top over there. Then we had the first touch point. 1, 2, 3. That's the third touch point now. This one over here, we've hit that line for the third time. Now, it could potentially hold on this time, which could be the final rejection from the zone. However, in my experience, usually by the third, fourth, definitely the fifth touch of a trend line, it tends to break. What that means is you kind of want to be positioned and prepared for the possibility of a spike to the upside. And what that would look like is this. That would mean that you would then fall within a range, which I have outlined to you guys also on previous streams. You would then be looking to fall back into a range. So it would lead to an explosive break if that trend line did break, and I believe it would come up and capture this liquidity. That would be a massive rally all the way up to 4,300, which is quite a bold claim. I don't want to claim that yet unless it starts to close above this trend line. As you can see, it's currently respecting it and rejecting from the zone. Let me just zoom in. So zooming in, you can see that we have got a rejection. Look at that candle, big indecision over here. And now it's going to come down to this week and how the stock market opens. Currently, we're opening to the downside. Let's see if this fall back into the 200-day moving average. So put your S&P 500 futures chart on a one-day chart, put on the 200-day moving average, and just monitor that. If it starts to use this as support, then I would start to lean towards the probability that we're going to break this trend line. And if we do break this trend line, it's going to be explosive to the upside. On the other hand, to the downside, you want to be tracking this trend line, which is a very simple one over here. If we start to fall below this trend line, it could start to lead to the next aggressive move to the downside, at which point you would expect that the VIX would pick up steam here as well. So the VIX would start to expand up. But looking at the VIX over here, it could track down a little bit further. You can see it likes to get down to this area in at least the prior year, anywhere between about 18 and 16. We're currently at 19 on the VIX. So that's that one over there. Looking at the daily chart, I have marked out with the vertical lines the CPI and the Fed decision, which is on the 13th and the 14th. I recommend you do the same. And again, it's tying in with this as underside resistance coming into these zones over here. There is a potential push up to $18,100. So keep that in mind. Now, talking more to the short-term traders, the guys that are trading on a daily to every couple of day time frame. This is the chart for you. It's the 4-hour chart. I did outline that target, which was the 200-day exponential moving average. Excuse me, 200-day, the 200 exponential moving average, the blue one. We have tagged that. Price is rejecting off of that. But the way that price is grinding up into this resistance over here, I am leaning towards a possible short squeeze where if it breaks through the June low, it's going to accelerate very, very quickly to 18,150. What does that mean? That means that if you are already in a long trade, it's probably worth holding it. Maybe you cut off 50%, take your profit into this moving average or the exponential moving average, and then leave the other 50% with a tight stop loss in the possible scenario that the continued grind into the resistance. Whenever you see price consolidating into a resistance area, so let me just draw it out for you. You have your main resistance area over there, and you see price coming up slowly into that resistance, and it's just grinding and grinding and grinding. That usually leads to an explosive move through that level, and that's kind of the way that I'm looking at it on the low time frames at the moment. That's what I'm thinking is probably going to happen. Next area of interest is the June low at 17,592. If it grinds into that zone, I think it will break it, and then I'm looking to build a short around $18,000. So that's what I'm looking at over there. You can see when you look at the different cumulative volume deltas for both spot and derivatives, the derivatives continue to lead the move. So stablecoin futured market, so the guys that are trading on leverage, they are the ones that are pushing the price up. And you can see that because the white lines are increasing, right? Increasing aggressively. Every aggressive increase that we have with the white lines, see if I can make that bigger for you, leads to an aggressive upside move in price. Let's just fix that. There we go. Make that bigger. Okay, and then you'll also see over here the orange line, which is the spot. The spot has been selling off ever since. So what they're doing, and I've mentioned this before, have you guys still got me? Am I still there, James? I think I can see you. Okay, cool. Let's continue. So the orange line denotes the spot traders, which are now starting to chase the leverage traders because they're obviously getting a bit of FOMO. We broke through the mid-range resistance over here, and this lines up with the same thing. Liquidity grab coming in at 18,200. Those are the levels that I'm watching, at least on this chart over here. So keep an eye on that. Let's go on to the low time frame. This is the long trade that I gave. I'm going to update you guys on this trade with, if you are in this trade, the Bitcoin long. What I would suggest you now do is completely move your stop into break even, leaving that slightly below mid-range. If price comes back down below this mid-range again, you'd want to be stopped out of that position anyway, because that's going to be a major bull trap. What are the levels or the ranges? Mid-range I have here labeled at 16,959. Key 2017 level over here was a strong open and close in 2017. It was at 17,230. We have cleared through that level. As long as we're holding above this, I would continue to hold these longs. Then you got the June low, and then after that, the range high at 18,150. So that's what I'm watching. I want to tie in with this tweet over here, what Skew's looking at for the low time frames. And he says, BTC, that being said, I don't like this for two reasons. Spot is selling into the futures bid, which is what I just showed you. The leverage traders push the price up, and then they sell their spot positions into the artificially elevated, if you want to call it, a price due to leverage traders. He says, high sustaining futures premium over spot. both factors indicate a change of hands over here. So you do want to keep an eye on that. But if you look at what's going on in Binance, he did update it. He says mostly overhead supply from spot being sold into price until recently. Recently, there are some spot traders which started buying, which is happening on the dips over here. So those spot traders begin to chase price. So what I'm basically saying over here is that if you do look at this, although for the most part, you want to fade the leverage traders that are pushing price up, because eventually they're going to have to close their leverage positions because they have to pay premiums to hold them open over time. So they will usually take profit into resistance and consequently price comes down. But sometimes if they hold it for sustained periods and they start to break key levels of resistance, spot traders may start to jump in the market because they see a shift within the market. So a leverage trader or leverage traders combined could potentially lead into further upside, having spot traders chase that, and then that changes the whole market dynamic. So keep that in mind. That could lead into a short squeeze, which if you look over here, you currently have pretty much it's about 2-to-1 of shorts versus longs. So basically, or at least 2/3 of the people are running shorts, which means there is a potential for a short squeeze. Alpha BTC, just finish off with this as the final tweet. He says, one more wave up for Bitcoin before a larger correction. Just some thoughts, but loving this fib channel. And I thought, let me just show his fib channel. It looks better than mine. And he's got similar levels over there. Look at that. His final top comes in at $17,850. So very, very similar levels to what I'm watching. And that is what I'm looking at. I'm currently in an Ethereum long over here, up 8%. I'll probably hold this, cut half, and leave the other half in case of a short squeeze. If you do want to join in on the trades or the competition, make sure that you join using the Bitget competition link over here. Everything is below. If you don't have an account, use any one of those links as well. Join the Discord group. I do update the guys in the Discord. I warned in the Discord group earlier this morning that I think that we could have a bit of a short squeeze and price could accelerate up. If you're not in that hub, then that link is there below for you as well. You can use any one of these links, or OKX, Bitget, or BYBIT to join into that Discord group. And I think that brings us to the end, guys. Thank you so much for your time. Please do give the video a like. Hit the bell notification and subscribe to the channel if you're not already. I do apologize for the interruptions that we've had during the stream, but hopefully you derive value. Let me know in the comments what you think of the show, and have a fantastic day. I will see you all tomorrow. Cheers for now.